Thanks for clicking. Mortgage growth in Canada is slowing, with the potential for an increase in defaults. This according to the latest residential mortgage industry report, just released by CMHC. The report comes on the heels of another widely publicized report from CMHC, showing that Canadians now owe more than our entire GDP combined. And the report also comes as the big banks have released their earnings reports, showing that they have put aside hundreds of millions of dollars in loan loss reserves in anticipation of potential defaults coming from the higher cost of borrowing.
Good. Right.
Indeed, and the CMHC report shows a mortgage industry that is shifting, with preferences changing, delinquencies rising, and access to mortgage funding getting more and more difficult. The report paints the picture of an industry that is reeling from the 425 basis points in rate hikes that we've seen over the past year. So what I want to do today is go over the CMHC report, taking a look at the slowing growth of mortgages, as well as the upsurge in delinquencies, and then take a look at the changing trends in where and how Canadians are getting their mortgages. The end of the month is fast approaching, and we're expecting to get May's real estate data out from the local boards late next week. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. On to CMHC's report. The report begins by showing that mortgage growth in Canada has stalled. While we saw a major uptick in mortgage growth beginning in 2019 and obviously surging upward during the pandemic, that growth has plummeted as the higher cost of borrowing kicks in. And mortgage lending is down all across the board, with mortgages for purchases down 34.2% and mortgages for refinances down 32.2% as well.
What would you say you do here?
But the slowing of mortgage growth makes sense. As we've seen on this channel, there aren't nearly as many purchases due to the lack of listings, and for refinancing, unless you're paying off higher interest debts, the allure of refinancing at 5+% in order to pay for renovations just isn't the same as it was when the rates were down around 1.5–2%. But for those who are still taking out mortgages, preferences have changed, as a lot of borrowers are betting that the Bank of Canada will be reversing course on interest rates over the next few years. 5-year fixed mortgages are becoming less common, with more and more borrowers opting for between 1 and 3 year terms. So the idea is that over the next 1 to 3 years, the Bank of Canada would have caused that recession, would have had to have reversed course, and then those borrowers in those 1 to 3 year terms can cash in on the stimulative monetary policy that so many are hoping for.
When that day comes along, I'll be right here waiting for you.
With that said, it is worth noting that Bank of Canada Governor Tiff Macklem recently stated that we can expect rates to be higher for longer, and that he expects mortgage payments to rise into 2026, or 3 years from now. However, the governor also said that inflation would be transitory, and we all know how well that turned out.
Fair enough.
So, just briefly, as with anything, when you're choosing your mortgage term, make sure you include your risk tolerance in your calculations. The report also showed that Canadians are acting much more risk-averse than they did during the pandemic. Variable rate mortgage use hit its pandemic high in January of 2022 at 56.9%, right before the Bank of Canada raised interest rates.
I mean, what's the worst that could happen?
Since then, variable rate usage has plummeted and now sits at 16.7%. So a major drop in the use of variable rate mortgages. And this risk aversion on the part of Canadian mortgage borrowers makes sense, and especially considering the growth in delinquencies on auto loans, lines of credit, and credit cards reported by CMHC, and that which we've talked about before on this channel. And while CMHC does stress that mortgages and home equity lines of credit are not exhibiting the same patterns as the auto loans, lines of credit, and credit cards with late payments, they do note that mortgages and HELOCs are lagging indicators and could show up later on. In fact, certain types of mortgages with certain types of lenders are already seeing an uptick in the number of delinquencies, with alternative lenders showing an increase in mortgage arrears since the second quarter of 2022. And I can say firsthand that this makes sense. During the pandemic, alternative lending rates were sitting around 2.5%, 3%, maybe 4%. And since then, upon renewal, I've seen rates come in at 8%, 9%, 10%. That's a major increase in interest being charged by these alternative lenders on these mortgages, many of which are only on 1, 2, and 3 year terms.
I wouldn't worry about it.
And CMHC reports that these alternative lenders, which have received an uptick in the number of requests for new loans, and despite the higher interest that they're charging, are also lending much more conservatively than they did in the past. Indeed, CMHC says that investors, those those which constitute a large portion of the alternative lending space, may be seeking better returns elsewhere and don't want to get involved in a cooling housing market. Alternative lending in general is a short-term solution, and alternative lenders lend out between 1 and 3 year terms. During those 1 and 3 year terms, borrowers fix whatever was preventing them from getting into A lending, be it credit, income, etc., after which the plan is to move over to the A side. However, with mortgage rates so much higher than they were 2 years ago, even 1 week ago really, borrowers are having a much more difficult time switching back over to that A lending space and are having to pay the renewal rates being offered by these alternative lenders. So we have more borrowers wanting to stay in that alternative space, we have more borrowers wanting that alternative money at a time when alternative money is pulling back. Ergo, interest rates go up. And I think that's the main thrust of this report. Access to funding, the provision of funding, is slowing down. The Bank of Canada has sent the message to the market that money is no longer cheap, money is no longer as easy to come by as it was during the pandemic, and the markets are responding. This is exactly what the Bank of Canada wanted to happen. They wanted to see less money entering into the economy. They want to see a major slowdown in the number of people refinancing. People don't refinance, homeowners don't get renovations, they don't travel, etc. That's less money entering into the economy, which should eventually induce that recession. This pullback in funding, both on the demand side of coming from borrowers and from the supply side coming from the lenders, was all a part of the Bank of Canada's plan to slow down the economy. And judging from this report from CMHC, it does look as though it's working. Slowly, but it's working. Whether or not the Bank of Canada has sent enough of a signal to the market to slow things down enough to get our inflation rate back down to 2% remains to be seen, but we'll obviously continue to track Canada's inflation and its economy and the Bank of Canada on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.